Hey everyone, Dave Keller here with Market Misbehavior. Today we're going to talk about what's next for Tesla. So Tesla, of course, included in what is now being known as the Magnificent Seven. We've talked about the FANGs. I've called them the Phenomena stocks. We're settling into these seven sort of mega cap growth stocks. Tesla, one of those seven, really, I think, tells the story of the market environment. If you look at 2022 to 2023 and how this stock has behaved, it's really, in some ways, matched the performance of the overall benchmarks, but really shown the extremes in optimism and also the extremes in pessimism that have occurred for growth stocks here over the last 12 to 18 months. What we're going to do today is do what we call the choose your own adventure approach. We're going to talk about Tesla. We'll sort of set the stage with a technical review of where we've come from, focus on the current conditions, and then give you four different scenarios from the super bullish, the mildly bullish, mildly bearish, and super bearish. Review each of those four potential scenarios over the next 6 to 8 weeks. Drop a comment. Let me know which one you vote on and why. We'll gather all those together, try to make sense of where we think as a group that Tesla may be headed. Should be fun. We've done this for the S&P, the Qs, and other assets before. First time doing it for Tesla. Let's look at the chart here. Before we get there, by the way, if you like this sort of thinking about investor decision-making, technical analysis, behavioral finance, and so much more, why not subscribe to my channel? Also, give the video a like if you appreciate it. We would super appreciate that back. Don't forget to vote below. Which of these four scenarios and why? Let's get to the four scenarios. To set the stage, here's the chart of Tesla over about the last year and a half. And what I want to do is just show about a year and a half ago, we're up here in the upper 300s, which feels like a long time ago. And it was, both in terms of price and time. But if you look at what happened really through the course of 2023, Tesla really accelerated to the downside into year end. It actually made a new low for the cycle in January. You remember that the S&P and the NASDAQ actually bottomed out in October. So Tesla was actually a rare name that continued lower and made a low in the first quarter of 2023. From there, though, talk about turning on a dime. Underperforming dramatically in the fourth quarter of last year. First 6 months of 2023, a nice acceleration to the upside, sort of a V-bottom sort of phase. Then you had this sort of downtrend phase in the markets themselves. The broader indexes pulled back February into March. If you know the S&P, though, the S&P actually rotated higher in April and May, while Tesla actually made a new swing low in April. So while overall the trend in Tesla being down in 22, up in 23 sort of mirrors what we've seen with the S&P, you have to remember that the dynamics of this particular stock a little bit different. That's why the relative strength line pretty varied, right? There are stretches here where the stock has been outperforming and stretches where the stock has been underperforming, both in bull and bear market phases. Now, if you look at what's happened in the last 6 weeks or so, you've seen this definite rotation. And much like a lot of the other growth stocks I could bring up, like Apple or Microsoft or many others, you've seen an uptrend of higher highs in June and July. Like many of those growth stocks, we see a bearish momentum divergence. The high in June, strong upside momentum. The high in July, even though a higher price high, the RSI is actually sloping downward. So weaker momentum as we make new highs. That usually suggests we're at the later stages, sort of the 8th or 9th inning instead of the 2nd or 3rd inning. Now we've seen it break down. Now the gap lower here in mid-July I think was pretty telling, because it's always interesting to see when you have a gap like this, what happens right after. Based on what I've seen here from the initial gap and then the continuation, this is what we would call a breakaway gap. A breakaway gap is what usually happens at the beginning of the move, right? Actually, after you've had a big run, you reverse and you have that first sort of big gap. And that usually indicates a change of character, that the momentum that got us to where we were before has now changed. The fact that we gap lower and then continue on means people aren't buying on this dip. They're actually using it as an opportunity to take additional profits or to unwind positions. And what happens is that selling pressure tends to beget further selling pressure. It's a negative feedback loop. And now, along with many other growth stocks and others as well, Tesla is now below its 50-day moving average. 50 days now sort of sideways, no longer sloping upwards, but now sideways. Now, what else can I point out here? Now, in terms of other ways to sort of quantify that breakdown, see, another thing you could do is take a trend line from the low, connect that to a swing low. That is maybe the most poorly drawn trend line in the history of market misbehavior. So let me tweak that just a bit. There we go. So now we're taking the low in January, the low in April. Lines up pretty well with the low in May. You can see this week we're now closing below that trend line. Again, the major averages all threatening those trend lines as well. The QQQ, I believe, just broke below its trend line, taking the previous low. So this sort of breakdown really confirms that we've rotated from an uptrend phase to a downtrend phase for now. The question, of course, is what comes next. Other technical evidence to point out: the 200-day moving average, not too far below, right below $200 a share. Big round numbers often have meaning, because when that first digit changes from 2 to 1, that's a natural time where people kind of revisit a thesis and just think, okay, is this really a sub $200 stock? A lot of times that can provide a bit of a bounce when we near that level. You also can note that the RSI is oversold. And if you look at previous times when the RSI is oversold, it usually means at least a tradable bounce to the upside. We're kind of right there as we end this week. Finally, I would tell you Fibonacci retracements can often be an interesting way of making sense of things. And so what I like to do here is take the low in January, go to the high that we saw just recently in July, and then we can take a 38.2% retracement back down. You can see we broke down through that level this week. The next major Fibonacci level would be the 61.8% retracement level, which is right here around 177. But note the 50% level, which a lot of people put a lot of weight on, is actually right at 200. So big round number, 50% retracement, and the 200-day moving average all coalescing right around the $200 mark. So what's next here? Does Tesla continue? Is this breakdown below the 50-day and breakdown of Fibonacci and trendline support just the beginning of further deterioration as the mega cap growth trade continues to unwind, as the prospect of higher rates really weigh on stocks like this? Or do we start to get a bounce? Do we find support leading into the 200-day moving average? The RSI is oversold. Does that suggest an impending rotation higher? Do we retest the highs from July? Do we continue on and threaten all all-time highs sort of in that upper $300 to $400 range? That gets us to really the purpose of this video, is to think about probabilistic outcomes. A probabilistic analysis is all about taking a chart like this and thinking of different possibilities, right? All of the things I'm about to tell you, these 4 different scenarios, are possible. I would argue some are much more probable than others. But the point of this is to sort of disconnect from any preconceived notions or biases that you may have, and force yourself to think about a very bullish outcome, a very bearish outcome, and some outcomes in between. What would that look like for the stock? How would you take profits or add or subtract positions based on these different things? If you were short a name like Tesla, at what point would you think of covering those shorts and going long? If you're long and strong Tesla, at what point would you think about unwinding that long position or taking some profits? By thinking about different alternative scenarios, it can help just disconnect you from whatever biases or narratives you're plugged into, and just force yourself to think about different possibilities. So with that in mind, here are the 4 potential outcomes. Let's start with the super bullish scenario. What would happen here over the next 6 to 8 weeks is this RSI oversold condition really takes hold. And similar to the bottom in April, we've now retraced a bit. Similar price level in terms of the retracement that we saw back in February into May. We've done about the same amount, maybe a little bit more. But this RSI oversold condition suggests we're near the end. Buyers indeed come in. Stock finds support right above 200 and then rotates higher. Instead of stalling out here in this area back up to the July high, we power even higher. New buyers come in, and once investors recognize that Tesla is now a recovery story, they're desperate to get in. FOMO is palpable as investors are afraid of missing out on the retest of all-time highs. That would cause a push above 300, and actually we would talk in about 6 to 8 weeks going into October about Tesla's ability or a possibility of breaking to new all-time highs in the 4th quarter. Scenario 2 is the mildly bullish scenario. Maybe all-time highs is a little aggressive, but let's say we find a bottom. So similar to scenario number 1, we don't get much lower than this, right? We'll say 200 is probably a likely floor in scenario number 2 as well. Again, similar sort of story where the growth trade, which has retraced, I mean, again, these leading growth names have given back quite a bit from their overextended conditions there in July. Enough buyers come in, start to buy in on this dip. The RSI oversold condition plays out beautifully, and we rally. But as we sort of retest the July highs. Rates are still, we're talking about the Fed maybe raising rates. Investors are not that optimistic, so it's more of a choppy sort of sideways environment of upswings and downswings. But 6 to 8 weeks from now, we're sort of in that, we'll call it 225 to 300 range, sort of in this range outlined with the number 2. Scenario 3, the mildly bearish scenario. So in this case, we have to start talking about support not holding. Instead of finding support at the 200-day, stocks like Tesla actually continue lower, and we fail to hold support. This is when people start talking about some nightmare scenarios like the S&P retesting its October 2022 low. We start thinking about downside protection, talking about getting defensive. But an interesting thing happens as we get into sort of September, the beginning of October. All of a sudden, these stocks have had such a sell-off, similar to scenario number 2. Investors start to realize that they can now get a really good company like Tesla at a deep discount. That buying, that opportunistic buying in the lows doesn't propel us anywhere near new highs, but it does sort of stem the tide of this downtrend, and we start to settle into this range. We'll call this between 175 and 225. That would basically, from a technical perspective, keep us right around the 200-day moving average, keep us between the 2 core Fibonacci levels, and would actually make a ton of sense. This is sort of a basing scenario. Instead of Tesla going up or going down from here, we more settle into a range, an equilibrium sorts, as investors sort of recognize that for now, Tesla's worth about $200 a share, and all we're doing is kind of overshooting and undershooting that potential level of equilibrium. Now, scenario number 4, the uber bearish scenario. This is where the initial sell-off that we've seen from Microsoft and Apple and Tesla and other leading growth names, we've broken through the 50-day, we've broken through Fibonacci support, and we just don't stop. As investors grapple with rising inflation, the Fed's attempts to keep inflation in check by rising rates has the double whammy of not working because we start getting inflation data that's a little stronger than normal, but also it makes things a lot more expensive and it makes consumers a lot less interested in spending money, which also weighs heavily on growth stocks like Tesla. This is just the beginning of this move, of a multi-step move lower, and all of a sudden in 6 to 8 weeks we are now handicapping the potential of a stock like Tesla making a new low before the end of the year. So instead of new highs being on the table and S&P 5,000 being something we're talking more about S&P sub 3,000. We're talking about downside potential and what the recession really gets into as we go into the seasonally weakest part of the year, August and September. Those are the 4 scenarios. The super bullish scenario, Tesla 6 to 8 weeks from now is above 300. The mildly bullish scenario, scenario number 2, we're between about 225 and 300. The mildly bearish scenario, scenario number 3, we remain between 175 and 225, kind of settling into this consolidation range. And the very bearish scenario, scenario number 4, where we finish 6 to 8 weeks now below 175. Which of these scenarios do you see as most likely and why? Leave a comment, give me your vote, and how you would justify that using fundamental, technical, and whatever other inputs you think are worthwhile. For Market Misbehavior, I'm Dave Keller. Have a great one. We'll talk to you again soon.